So we'll make sure to make that available for everybody who can't be here in real time. And I'm thrilled to be here with an amazing panel of guests today, talking about verifiable financial data in Web3. So I think the common term that most people are aware of is proof of reserves or proof of solvency. Trevor, I think when you chatted with Jason Myers from Auditchain, he was calling it proof of state. We used to call it proof of accounts on our side, but I think that the key concept is that we're seeing a really big shift where financial institutions are establishing financial data sets that can be verified without disclosing private information, like specific positions or account activity. And this panel in particular has been instrumental in helping me to learn about some of the key topics here. And I want to start by taking a minute for each of you to introduce yourselves briefly to our audience, including your backgrounds and why it's important to you. So Duncan, why don't you kick us off?
Thank you very much, Omar. So yeah, my name is Duncan Fitzgerald. I'm a partner with PwC in Hong Kong. I co-lead our digital assets or crypto practice for everything that we do as a firm in Hong Kong. So that covers deals, accounting, tax, audit, assurance, etc. My personal area is on risk and controls and governance. I focus mostly on what I would call traditional crypto, which is like the exchanges, the platforms, the funds, custodians, etc. And my colleague looks after NFT, Web3, Metaverse. I've been involved in the space actually, and I remember my very first meeting in 2017 in the ICO boom, when we were looking at governance and control for vehicles that went through the ICO journey. It was like the Wild West, and was in some respects still there. So I'm looking forward to the session today. Gerrit.
Yes, my name is Gerrit from Wingerden. I'm a partner and founder of Mercury Capital. Mercury Capital is an asset manager focusing on digital assets. We'll be launching our first hedge fund next month. It's a market neutral fund that invests primarily in DeFi. Before I started Mercury Capital, I was a co-founder of a company called Torah Trading Services, which is now part of the London Stock Exchange Group. Torah built and offered a cloud-based platform to traditional, primarily hedge fund asset managers, as well as some CeFi asset managers offering services such as order and execution management and portfolio and risk management. Trevor?
Fantastic.
All right. This reminds me of like popcorn reading from elementary school, where you just say the person that needs to read next. I'm Trevor Ward, CEO and co-founder of Multisig Media. We are the premier source for Web3 education and news for accounting and finance professionals. And right now we're working on building out a CPE platform for just to help onboard professionals to the space. I'm also a CPA, started my career in public accounting, and actually discovered cryptocurrency when I was working at a foreign currency brokerage, and sort of saw it through this lens of how digital currencies can help solve some of the problems that we see when moving money around the world, and have been falling down the rabbit hole ever since.
Well, it is a beautiful rabbit hole with plenty of fun subjects to dive into. But today, let's stick to those verifiable financials. So just to wrap up our intros over here, I'm Omar ElNaggar, the co-founder and CEO of Weavechain, where we do secure data exchange for Web3. And one of the products that we built is Accountable, which is all about this verifiable financial data. So let's start with a quick agenda for the day. And really what I'm hoping we can get out of this is to sort of understand a little bit more about what's been happening over the past few months and prepare for what's coming. So I'll kick things off with a little bit of a history. And we'll start with the FTX crash itself, which was a particularly important catalyst for the space. And then we'll move on to the evolution of proof of reserves technology, and dive into attempts to implement it from Binance and a few major auditors in the space. Then we'll engage our panel to talk about some more recent events, including what else has been happening, the challenges of actually performing audit in this space, and a general look of the trials of what I'll call FinTech 2.0. And we'll wrap up with a look at what's next, including what are the sort of organic incentives that would drive the adoption of this technology, followed by the regulation that will force the adoption of this technology, and what our approach is to what I'll call sort of FinTech 3.0. But again, let's start with that history over here. And it all really begins in my mind back in November with the FTX scandal, which, it's still all alleged, but it appears to most people that FTX has committed fraud. the $5.5 billion in assets that they have does not cover the $8 billion in liabilities that they owe to customers. Now, there was an outstanding presentation that was submitted to the Bankruptcy Court of Delaware that outlined some of the larger events that were particularly concerning here. The most interesting of which, for me, was a $65 billion backdoor that was established for Alameda Research. Now, Alameda Research was a hedge fund that was started and owned by Sam Bankman-Fried, who is also the founder and CEO of FTX, the cryptocurrency exchange. Now, for most people in FTX, there were auto liquidation rules for margin trading based on the user's collateral. This was not the case for Alameda Research. And this is one of my all-time favorite slides showing this egregious loophole over here of a $65 billion limit that they had on activity. So again, following this collapse and a tremendous loss of capital and let's say reputation for the space, everybody is clamoring to figure out how we will prevent this from ever happening again. And, a lot of people say that if FTX had a proof of reserves report, that, committing this kind of fraud would have been a lot harder. Now, the term proof of reserves is sort of deep enough in the zeitgeist that people use it interchangeably with a proof of solvency, where the idea is that financial entities should show in a verifiable way that their assets are greater than their liabilities. Now, this is actually not a new idea. In fact, exchanges like BitMEX and OKX implemented it as far back as 2014. But as I like to say, security technology always sort of starts off as a vitamin before it becomes a painkiller and a regulatory requirement. And we're seeing that shift happening right now. That's why this curve is taking off. And I highly recommend diving into Nick Carter's website if you want to understand the mechanics of how different people are implementing this technology. But really relevant to our case here, we have Binance, the number one crypto exchange in the world by volume, trying to implement proof of reserves as a painkiller because so many people were afraid that they were doing the same thing as FTX. Now, they launched a proof of reserves product for their users in late November of 2022, and they even got an auditing agency to provide some collateral supporting it less than a month after the crash. But let's just say that their implementation was not a complete success in the court of public opinion, nor behind the closed doors of governments. And one of the key sources of strife was, in fact, that the report that Mazars submitted on behalf of Binance, which on the surface was a heroic statement that Mazars used to go and promote their service Veritas, where they're going to go do this for the biggest exchange in the world. This was not actually a formal legal opinion of an auditor for an exchange. It was a hedged approach where Mazars was effectively saying, yes, we validate that the Binance's math for this particular calculation looks okay. Regulators did not like that. And Mazars had to retract all of those statements and shut down this entire practice. I actually was only able to pull up this website using the Internet Archive's Wayback Machine. Now, they are not the only group that actually suffered in this fallout. Armanino also offered a proof of reserve service for clients. They were pioneers in this space, and they were the auditors for FTX. And suddenly they also had to go and crypt all of their crypto clients after 8 years of work. Why? I am betting that they got some nasty phone calls from the SEC and other parties. You remember that nice green check mark on the Binance website? Well, the SEC did not like that it was not a formal audit and thought that it was actually misleading customers. Now, we've seen a sharp increase in regulatory activity over the past few months. On December 8th, the SEC issued a sample letter literally as a heads up to any company in the world as to what's coming. Then on January 4th, the Fed, the FDIC, and the OCC issued a joint statement saying, banks, you better be treating your crypto assets like fiat assets. And on January 23rd, the New York Department of Financial Services said outright, crypto companies, you cannot commingle customer assets with your own assets. And on January 28th, we get another statement from the Fed. And just this week, on February 20th, the SFC out of Hong Kong issued a statement, really emphasizing that banks need to go and start treating these assets the same way they do with regular assets, with plenty of staff to go and support those operations. So, with that context, Trevor, I want to ask you, because you had a great discussion in December with a bunch of people looking at this. What do you think has happened in this space, let's say leading up to that conversation you had in December and since then?
Yeah, that's a great question. Also, I have to note that I wore my new favorite shirt, the FTX Risk Management Department. Obviously a joke. But yeah, I think that's a really good question. The Proof of Reserves War Room for us was very interesting because we intentionally brought people on that would have differing viewpoints. For example, we had someone from BDO, so very traditional audit background. We had the CEO of Bitwave, an accounting SaaS product, someone from Chainlink, someone from a non-custodial wallet provider, Giddy. And I think the general consensus was, yes, there's a huge problem. I think there was also consensus that you can't just look at assets, which that was what a lot of companies were doing at the time, which really did not give a clear picture, because it's the same reason we have in a balance sheet, we have liabilities and assets, and we're not just looking at, hey, here's the cash that we have. But there was a lot of varying opinions just on how to solve this issue. For example, the non-custodial wallet provider, their approach was, hey, well, we shouldn't have funds on exchanges anyway, take them off, take custody of your own crypto, which I think works really well in theory, but I think we will always have on and off ramps into digital assets. And so I think there's a few different spectrums. There's a spectrum of, we can solve this through traditional audited financial statements, which was kind of Coinbase's approach. They said, we are a public company, therefore we have a full financial statement audit, and that is our proof of reserves. On the other hand, you have this argument that you can have a potentially completely cryptographically proven proof of reserves or proof of solvency, but I don't think that we're completely there, and I think that has its limitations. So there's all different ideas on how to approach this problem, and I think exchanges and custodians, if they weren't aware or they weren't thinking about this before, they definitely are now. And you are seeing much more, almost every major exchange has kind of been forced to make a statement about where they're at in this process. And many of them have kind of hustled to produce. And I think that, personally, I think that's what happened with Binance. They were sort of caught off guard, and that's why maybe it wasn't the most buttoned up proof of solvency that we've seen.
No, that's a great kickoff right there. And, Duncan, maybe we could have you step in to talk a little bit more about, what were the problems with the report that Mazars generated for Binance and their sort of approach.
Okay. So the whole accounting profession has been grappling with what to do with what's called proof of reserves or statement of reserves. And I'm going to say providing comfort, because sometimes people use the word assurance and it's got like auditing connotations, but providing comfort to people that about solvency and reserves. The agreed upon procedures type of work that's been done by Mazars, etc., is only a limited set. And as they quite rightly pointed out, it's not an opinion. But there are lessons that we should learn and remember from the traditional asset management and financial services industry, and they are as follows. Yes, you can get an opinion over assets and liabilities like in a traditional financial statement. But as people in the asset management world recognize, is that if you've got service providers, and here we're talking about maybe a crypto exchange, well, if it was a fund administrator or another exchange in the traditional world, you want an internal controls assurance opinion report from somebody like a CPA firm. So that's where these internal control reports and assurance things are so important as a complement to also some comfort over assets and liabilities. So the mathematical validation of using tools like yourselves, Omar, is brilliant, but it needs to be complemented with what are we doing about the governance and controls aspects as well. So let me show you a story about why this is important about internal controls. In the equities world, if I owned a company, I had 78% of the equity, and I listed the remaining equity on the stock exchange, I would be a very controlling shareholder. I might also have my own private group, my private business to the side. If I was unscrupulous, I would want to be able to do transactions between my private group and my listed group. And obviously I would want to benefit the private group because I own 100% of that, and therefore I could be disenfranchising the public shareholders. So that notion of connected party transactions is very well understood by stock exchanges, and there are rules and regulations about that. So now let's turn to a lesson like FTX. Why was FTX allowed to do all that business and credit lines with Alameda? It's because of a lack of controls and governance at the controlling shareholder level. And there should have been rules and regulations, arguably around that. So that's why I am passionate that things will progress and things will improve. But a statement of reserves or proof of reserves in isolation is not going to solve the overall challenge. And we should be learning from traditional financial services about how to do that.
You nailed it. I think, there's the new CEO of FTX, John Ray III, who did the Enron thing. When he came in, his statement was, never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here, referring to FTX. So, it's this situation is unprecedented because that just doesn't happen in a traditional financial institution that's dealing with audits from firms like PwC for these situations. Mm-hmm. Well, Duncan, maybe you could just sort of elaborate a little bit further here. Obviously, what happened before is not acceptable, and Mazars made an attempt here. But what are some of the challenges that you see that make doing a full audit of a crypto exchange or a cryptid entity so difficult?
Well, so there are two parts to your question there. One is the technical aspect of challenges, which I'll come on to. But but in order to be able to do the type of work that needs to get covered in order to provide customers with comfort, maybe public shareholders with comfort, it isn't just ticking some numbers across assets and liabilities and making sure that something is solvent. Because if it might be solvent today, but if you've got poor management that are unscrupulous, it doesn't mean to say they're going to be solvent tomorrow, because they could move everything around, move assets out, and therefore it's not the same situation tomorrow. Whereas if you've got a decent control environment, it's much less likely. There's no promise, but much less likely to do that. Turning to the technical aspects of challenges of auditing in this digital asset space, I see two main challenges at the moment. But bearing in mind that there are some crypto exchanges that do have external auditors. You've got Coinbase, you've got Bullish, etc. They're big four auditors that are doing that. So some people have already solved this problem. Okay, but the technical aspects are if an auditor wants to prove a balance, it can prove a balance. If it wants to prove ownership of a wallet, then how do you prove ownership of a wallet? In a bank account, it's quite easy to prove ownership of a bank account because you can go to the bank mandate and see who are the category A signatories, who are the category B signatories. That's what the bank does. Therefore, it's the control of the company. In a digital wallet, you might be told who's got the passwords, but what if other people have also been told the passwords and they've got control that you just don't know about it? So auditors have a struggle with this concept of sole ownership of wallets. And therefore, that's why some of the auditing requirements, particularly in our firm and others in the Big Four, say actually to get comfort over sole ownership, you need to have the comfort over the controls over the generation and passing of keys, but more importantly, about the key generation ceremony. And if you're not there at the start when a wallet is opened, how do you solve that? Only one solution really, which is to move assets to a new wallet and the auditor to be there at the key generation ceremony. And that is a cumbersome requirement at the moment. So the profession is challenged, and I sympathize with that because I can't see any other way of getting around that particular audit requirement of getting comfort over sole ownership of a wallet?
Well, I do think there are some tech platforms out there like Fireblocks and Copper where the key doesn't exist in any one place.
Correct.
Right?
So yeah, when you're using service providers like that, you're correct.
Okay. And I think if, like for a hedge fund, if you're not using a service provider like that, I mean, you're making a big mistake. So.
Yeah. I mean, maybe another topic is like, okay, if you are using a service provider like that because you're using self-controlled, and I use a self-controlled custody type solution off the platform,
right?
And then others are quite comfortable leaving their assets on platforms, and we'll come on to that maybe, Omar, just because what does that mean? Are they really segregated? The rules are saying you should be segregated. What if they're not? Then you're an unsecured creditor.
No, that's a great point. Maybe you could talk a little bit more about that segregation of assets, because I know that was a big focus of that statement from the New York Department of Financial Services.
So segregation of assets, and again, on the equities world, it's been around for donkey's years, ever since I started my career and way before, is that if you've got equities and somebody's looking after them for you, they can't be commingled with their own assets. They have to be separated in a client account. And it could be a client account which is by client, or it could be an aggregated account called an omnibus account with controls around that. But that's beautiful because in the event of the bankruptcy of your holder, then all those assets in a segregated account are still there and available for the customers. Now that, as you know, Omar, on your earlier slides, that concept is being rammed down our throats by the regulators, particularly in the US, and it is because to help with the flight to quality. But so the challenge will be, how do we ensure that there is proper segregation of client assets? This is where, again, it comes back to control and governance, is that you need to get comfort that the people that you're using, on whichever platform you're using, is adhering to those rules.
Mm-hmm.
And therefore, who's doing the ticking and checking to make sure that management of whatever crypto platform you want to use are indeed adhering to those rules promulgated by the regulators, and that's where our profession comes into play, to say that actually you need to go and get an internal controls assurance report over those type of things.
It does feel like we are like revisiting old concepts that have been established for a long time, and they just weren't applied to this new cryptid asset industry. Like we were talking about like SOC 1 and SOC 2 reports.
Yeah, you're
like
absolutely
maybe you
right.
can talk through again how they could be applied here.
Okay, well maybe I will. Maybe why were they not applied in the first instance? Is in my mind is that a lot of very young, imaginative, brilliant minds creating this industry, and they weren't necessarily brought up in the traditional corporate education background of what constitutes good governance and stuff like that. So actually, it was just a bit of a mindset that was missing, really, from the nascent industry, and it is coming. And with people of my vintage getting involved, because that's where we were brought up with that. So SOC 1 is a good internal controls type report, which gives people comfort over the legitimacy and integrity of financial information being provided by a crypto exchange or a custodian or etc. Those SOC 1. But it only gives you comfort over financial information reporting. Quite a lot of people also want to have comfort over the technology security controls over a platform. And that's where something like SOC 2 comes into play, which is basically a comfort report over the information technology security and control aspects of it, which has got more comfort on a forward-looking basis as well, because you want to make sure that you're less liable to get your assets hacked out of an exchange through SOC 2. But those type of assurance reports have been around in the traditional securities industry for donkey's years.
Yeah, for sure. Gerrit, like you were actually implementing these technologies, I'm sure.
Yeah, at Torah, it was a necessity that we had a SOC 2 audit done, right?
Mm-hmm.
Otherwise, no hedge fund would really do business with us, because all their trading and books of records were basically running through our cloud-based service. Yeah.
What were sort of like, challenges that you guys faced at Torah, let's say, when you were dealing with like reconciliation, reporting, what are
Right.
sort of the again, like things that have been addressed, 20, 15 years ago that probably need to be addressed again now for this new world?
Right. I mean, I think at the end of the day, like I'm coming at this more from a hedge fund point of view. The hedge funds all their assets will be, they'll have custodians, which are prime brokers. Will usually have, post Lehman shock, they'll have multiple prime brokers, and those PBs they're regulated. They have all the proper controls in place, and it's very easy once you are in agreement with your prime broker about what you've done on a day-to-day basis, right? There's a daily reconciliation process, which is often very manual because hedge funds will be doing things like they'll be trading hundreds or thousands of transactions with dozens of counterparties across many exchanges. Some of them are OTC. And in many cases, even today, right, this end of day reconciliation process will involve like CSV files being sent via SFTP or even email. And each sort of counterparty may have a slightly different format. And then you have things like there's different asset classes, and you may have sort of if there's a new IPO, right, that IPO may not be in your product master, or there could be a new option expiry or strike. That's not in your product master. That's going to cause a daily reconciliation break. You're going to deal with it manually. So on a daily basis, doing the reconciliation is a fairly still sometimes manual and onerous process, but hedge funds seem to get it done at the end of the day. And there are obviously tools that we've built and other by we, I mean Torah have built and other parties have built that make the process easier. But once you get it into the PB, I think it's very easy then for a fund administrator to go to the PBs, and have comfort, and an auditor as well. Correct me if you disagree with me, Duncan. Once you're getting the report from a Goldman and a Merrill that here's the accounts, here's the assets, you can be somewhat comfortable sort of signing off on the assets of the fund, and the administrator can be fairly comfortable signing off on the NAV at the end of every month. So
Correct.
it's right.
No, it makes sense, right? There's so much at stake here that it's worth going through these intense, laborious processes to make sure that things are being done right. So now we need to go and figure out how, let's say, that this new asset class is going to do the same thing. So Trevor, maybe I could jump to you and see, what else have you seen over the past few months as people have been trying to go and, let's say, sanitize operations? Everybody from Chainlink to other groups that you've been chatting with.
Yeah, that's a great question. So some of the more recent ones, BitMEX recently published their proof of reserve, or an update to their snapshot. And I think something important to note is that these are typically snapshots. And I think that's one of the challenges is there's no particular standard, at least from the PCAOB in the US. And I know that I read an article recently that said that there's been a request that like, hey, we need a standard in terms of frequency, how this is done. And so, BitMEX just released theirs. I believe Kraken also last year they did an update. OKX as well. OKX is probably an example of sort of the gold standard of, I'm meant to say Kraken is probably one of the gold standards in terms of auditor assisted user validation with Merkle tree approach, the frequency in which that they do their proof of reserves, and I say gold standard. I don't know that that's maybe not a fair statement. There's probably still an even better way to go about this, but and then I think Binance, Duncan brought up an interesting point there about proving control of wallets. That was one of the issues with the Binance audit is if you go and read the agreed upon procedures report, for a few of their assets, they showed the auditor observed them signing transactions from their wallets, which essentially would prove that they have custody of those digital assets. But then for another subsect of assets, they just they tagged those assets on the block explorer. So that raised questions like, well, why would you do it, prove it this way for one set and then another And so I think it just goes to show that as an industry, we have some work to do in terms of just coming up with a standard format for proving solvency.
I find this so interesting, even like the Kraken case in particular, just because, Kraken actually moved away from New York State a few years back because New York State was a bit forward with their regulatory policies. And, I think Kraken has been trying to do the right thing of their own volition ahead of, regulation enforcing it. And, that commingling of customer assets that we had been talking about earlier is something that the New York Department of Financial Services is now, issuing formal guidance for. So I'll sort of open this up to the broader group. How do you think that like regulation is going to impact everybody's operations on this front? Is it going to be something where we'll need that regulation for most entities to sort of adopt these new practices? Are people going to go and do it on their own? Are firms hiring lobbyists to go and try to steer the conversation in specific directions? What sort of thoughts do you have on where this space is going to be moving in the short term?
Maybe I can start with that one. Is that post FTX, and we've seen. You can look at the asset movements out. I think, quote unquote, we would all agree that there is a flight to quality, generally across the industry. Now, we still have a choice. There is still choice available out there for those people that want to use unregulated exchanges, and as long as they're consciously aware that if they want, certain exchanges have got massive deep liquidity, but they're unregulated and they're not being audited, it's a choice factor. But the institutional players are moving towards exchanges that are regulated and that are have got assurance type of reports, etc. So at least now there is more awareness about the choice available. One of your articles that you flashed up on the screen earlier, Omar, related to there was an article on SFC and saying for Hong Kong, saying, it's going to be massively costly. Well, actually, there are going to be some costs involved, but there are so many people wanting to go and get licenses in Hong Kong because they recognize the fact that people want to be able to use a regulated exchange. And for those that don't want to do that, then don't go to places like Hong Kong. Mm-hmm. It's about conscious choice on here.
Yeah, it's such a great point because, one of the problems is that like FTX was moving to jurisdictions where they were not going to be regulated. And, as a citizen of the United States, I couldn't actually trade it on FTX's global operation. Maybe I could have operated on FTX US, which has its own problems. But I believe FTX Japan had instituted, no commingling of customer assets earlier on. And it seems likely that all customers of FTX Japan will get all of their assets back, that they will not have, suffered from this FTX scenario, except for, let's say, the lock of their capital for a short period of time. But do you think that it will be a situation where these sort of major entities are going to make a push to go and hold themselves to a higher standard before regulation comes in as a way to, let's say, attract more activity?
I think the jury is out on that. I think that regardless, we're seeing regulations come on. I think there are some platforms that have grown so fast, okay, and they have structures that are like spiders' webs in terms of corporate structures. You look at the one from FTX as well. That's in the public domain. It's like a spider's web, and about where control comes in. They were setting up these vehicles and interrelated parties to be able to service customers, but it wasn't necessarily in a controlled manner. And there are others that have got very complicated corporate structures on there. So another reason why things are difficult to audit is unless you have an ultimate holding company that brings everything together and controls everything, it's a nightmare to try and audit, and if not, quote unquote, impossible to do an audit. And I think, that's some of the biggest exchanges, not Coinbase because they are audited, but some of the biggest exchanges have struggled with that.
Yeah, Duncan, I think you brought this point up in one of our other conversations where you were saying that, again, if like one piece of that spider's web is not going to conform to the controls of the entire process, then the entire web is effectively unauditable. I'm probably paraphrasing that poorly. How would you describe it?
I would agree with that, okay, but because it comes back into then why would one vehicle not be complying with everything? It's actually because of the whole control environment around the whole group. So it's you can't just point it, oh, it's this one vehicle. No, there has to be the root cause of why that one vehicle. And then that could be because of the governance and control and structure over the whole group.
That's very fair. Gerrit and Trevor, do you have any thoughts?
I'd actually like to go back to something Duncan said about flight to quality. I think there is an alternative, and the alternative is sort of non-custodial wallets, right? I'm a bit of a DeFi maximalist, and I think CZ at Binance had said they're making a move to basically, I mean, this already exists. There's platforms like this in DeFi. If you think of something, there's for example, there's an exchange called IBEX or IDEX. There is a perpetual swap platform called DYDX, and the funds themselves are held in your own wallet on chain, but you can interact with protocols that exist off exchange, right? So you can trade perpetual swaps, or you can buy spot from an exchange or a marketplace that isn't running on exchange per se, but all your assets are held and secured by your own keys, right? And so that is an alternative. And obviously, it requires a degree of sophistication. And then there's always the question of, like, if I'm holding my own keys, what happens if I hit the bus or I lose my Trezor, right? But that is something that is an alternative to just going to a quality exchange.
All right, so let me react to that, because I was on another panel in December where we were talking about like the whole concept of crypto exchanges, and are crypto exchanges really crypto exchanges in layman's terms? And what you've just been talking about is actually, if you go to a stock exchange, the stock exchange is a marketplace, and you hold your securities and assets not at the stock exchange. It's at custodians. Okay, so you're talking about exactly the same thing here. Is that if there is a move where exchanges become just marketplaces where you're not holding your assets, it's fine. Now, prior to November, and we've seen all of the crypto exchanges. Are they crypto exchanges, or are they just trading platforms where you're trading with and against the platform? And many of them were like that. So in a layman's language, arguably, it's a bit of a misnomer to call them crypto exchanges. They were trading platforms. So I think, Gerrit, you're right, is that move,
combined with custodians, right?
Yeah,
all
yeah.
exchanges.
So what I'm saying, but that move, what you're talking about, is actually moving towards the more traditional equities exchange model, and actually the layman will have the same understanding.
The only difference there is that in the equities model, you will probably not be your own custodian. I mean, you could be if you're like you will have a Goldman Sachs if you're a hedge fund.
I'll go back 25 years when we had paper share certificates in our safe in our own wallet. Okay?
Fair enough.
So you are right, but
that model and now you have but you also have a model I've seen now. There are platforms. I think it's called. I forget the name of the platform, but where basically it's more like a PB type model where institutions can effectively custody their digital assets with someone who's I don't know what the actual word is. I think it's a qualified custodian. And then they can trade on an exchange, and the exchanges are connected to the custodian, and they're just basically instructing them. It's more like an omnibus account in these custodians, and they're just exchanging ledger entries. So they're holding the crypto in cold storage, and then when you trade with someone on the exchange, if they're both custodied with this entity, they just make a ledger entry. And I think that's one way it's going, and the other way it's going is like I can hold, or my fund can hold, using the Fireblocks, our own crypto, but we can still interact with things off exchange to trade, to do trading, for example.
I think an interesting point as well, Omar, is just the proposed rule coming from the SEC this week on qualified custodians. And Gerrit could probably speak more to this than I could. This new rule would certainly heighten the requirements for becoming a qualified custodian. And granted, this is not a rule that is only specific to crypto, but Gary Gensler, clarified his stance pretty well in saying, and I have the quote right here, he says, "Make no mistake, based upon how crypto platforms generally operate, investment advisors cannot rely on them as qualified custodians. Though some crypto trading and lending platforms may claim to custody investors' crypto, that does not mean they are qualified custodians." And so, granted, this is not set in stone yet, and we have yet to see what happens with this proposed rule. But it could definitely change the landscape in terms of who is allowed to custody crypto on behalf of an RIA.
Yeah, so actually that concept, Trevor, about making sure that they're separate responsibilities. I don't know if you remember, if you cast your mind back to the era of Citibank and Travelers Group, okay, and then what happened with Madoff in terms of that, okay, different functions need to be split out on here. Mm-hmm. We've had, market making, custodian, exchange, all within one family of controllers, okay. So that whole, so I don't think we should just be talking about custodian. Actually, it's all the big types of activities that potentially need to be separated so that you're not reliant on one controller who could where there is the ability to abuse that power by doing that. And so regulators have forced that in other aspects of financial services, and I can see that the different roles and responsibilities in the digital asset trading ecosystem being forced to be separated.
Yeah. And I think that was the issue with FTX, right? You combined prop trading desk with custodian with
market making and
yeah. It was everything all under one roof.
Yeah.
With collective thievery thrown in.
Yeah.
Sprinkling of massive fraud.
Forget the last comment but all the ones about market making, custodian, whatever, they were all glaringly obvious to us as an industry, okay? But nobody shouted.
Well, now's the time. I would highlight though, it is like a lot harder from a technological perspective to achieve some of these end results with Web3 technology right now. Like Gerrit, I know you're working on a bunch of technology for how to enforce, let's say, things that would be easy to do in a Web2 trading platform, as far as like controls and things like that for crypto products. And even just today, I was working with a centralized exchange that's trying to do a non-custodial wallet solution that has, some form of like limits in place so that, if you're going to use a non-custodial wallet as a private company, that means whoever has control of that wallet can just drain that account, even though it's on behalf of an organization. Have you sort of been approaching any of those challenges and anything that you'd like to highlight?
Yeah, so we are using a platform called Fireblocks, which I mentioned before. And the way it works is that typically like two of the shards, not technically it's not a shard, but two of the pieces of the key are held by Fireblocks, and they have like this thing called a hardware security module, so they exist in there, and it's tamper resistant. And then the third one can be held by the end user. And that basically means that Fireblocks alone cannot sign any of your transactions, right? And the end user alone cannot sign their end transaction. And what normally happens then is you make a transaction in DeFi, like send these funds here, and then there's a certain set of human approvers who need to say, I approve this transaction, I don't approve this transaction. That works well for just sending from like CeFi, because you're just sending funds from this wallet to this wallet. It's very clear what you're doing. In DeFi, you're interacting with protocols, and none of these protocols have any sort of like a standard API or interface. They all look different. And so what you're really seeing, a human is seeing a string of bytes, and like, should I approve this or not? I mean, it's really hard a human can't parse that string of bytes and determine whether or not it's a transaction that's compliant with your firm's policies. So what we built for ourselves, and we're thinking about sort of spinning this out, is we have an automation that when we get called, when our shard gets, our user gets called to co-sign the transaction, we have a software that analyzes the transaction and it compares it with our compliance policies that someone who's not the trader, like the risk manager, sets, right? And then it will either reject it or approve it, depending on whether it's consistent. Now, we also have another human approver, and the purpose of that human approver is just more about the activity. Like, they know the traders, like if he's on vacation, right? A bot might not know that, or automated, and then it's an extra check. But that human approver cannot introspect these DeFi transactions. And so that's the real challenge, I think, in interacting with DeFi versus CeFi is all the protocol. There's no standards across the protocols, and you have to do a lot of effort to basically, and also when you're trying to see what the assets are, like if we have assets in 30 different protocols, interrogating those protocols to determine what's in them, you have to write 30 different pieces of code. So that's the real challenge. So.
And what's it like trying to like work with the other parties involved in the financial stack to sort of like share your domain expertise when they're trying to go and, you know, do audits or fund administration or anything like that?
Well, we haven't really started doing that. I think like our first, I mean, as I said, working with you guys is sort of our first step to doing this, right? We want to get the data out and then rely on a service like yours to then work with auditors. So we can give a stack to you. The auditor can run the stack, get the data out, and rather than have us run it, right? And then you can basically produce a proof to our clients, our LPs, that was initially prepared by an auditor, but so our clients will know we have the assets and AUM we say we do, but they won't have complete visibility onto all of our strategies.
Right.
And I think that's a key piece right there, right? It's sort of
right.
like, you know, that's your IP as an investment manager,
right.
Is that like the strategies themselves need to be, you know, secretive to ensure that nobody else can go and copy them.
And DeFi can be gamed, right? People can manipulate oracles. There's the whole, what was it? The Melon Finance. Maybe I'm getting the, you know, the guy's on trial now because he gamed a protocol and took $100 million out of it, right? If people knew we had certain positions, certain sort of loans that might be running at a certain LTV, they may be able to push them against us and force liquidations, and so it's very important that people not see what our positions are.
Yeah, for sure. You know, one just let us over here, we sort of like shifted gears a little bit, and I think it's important to do so, but you know, an investment manager is a different kind of steward of capital than an exchange, right? You know, we're sort of looping them into the same bucket here, but you know, do you think that regulation is going to be affecting these different stewards of capital differently? Will it make a distinction between them and their sort of requirements? Or, you know, if you were going to go and accept money from a party, are you going to be subject to the same kind of, you know, regulations?
You're asking me or the group in general? This
is
probably more one. Duncan,
Well, okay, Gerrit, I think you're better placed to answer that question.
Okay, so right now, depending on our jurisdiction, right, we are Cayman-based. Given sort of the nature of our LPs and the requirements that we have, we're subject to very minimal regulation, right? We do have to provide audits, right? If we were acting as an asset manager in Hong Kong, I think Hong Kong was probably one of the first jurisdictions to actually roll out regulation specific to crypto asset managers. Yeah. So in that case, we would be regulated. But where we are right now, and you know, given the types of LPs we have and the amount of funds we expect to have, we're subject to a minimal regulation as an asset manager.
Yeah, it's really fascinating. It makes sense that I think that exchanges are going to be regulated first. And I guess one of the tricks is just that, you know, as the world becomes easier to sort of navigate and move around, there are incentives for people to change jurisdiction based off of, let's say, what it was most the palatable regulatory climate for their current operations. You know, Duncan, if I'll let you close out there, do you think that there will be any sort of like differentiation in the regulation that's applied to these different entities forthcoming? And of course, it's impossible to sort of divine, you know, what the regulatory agencies are going to be pursuing next.
So, I think generally in the world in this type of regulation, there is more. I'm going to say there is more and more harmonization of type of regulation, and there is better collaboration and sharing of information across the regulators through bodies like IOSCO, the International Organization of Securities Regulators. But there will always be, for the foreseeable future, a mindset in many regulators, which is not a fear factor. And the fear factor is as follows: not on my patch and not on my watch. What does that mean? That means that they don't want anything to go wrong in their territory. And they don't want to get anything to go wrong whilst they are in their employment at their regulator. So not my patch, not my. Now, what that can mean is that they just impose things or ban things to move things offshore, so they can say, I'm not the one to blame if anything goes wrong. Okay, but is that really the right thing to do? Arguably, it's missing out on their societal duties to look after the people in their territory and their country. So that's one point to make. The second point to make is that we've all grown up particularly in banking and securities industries, which are regulated on a geographic basis, by country, by state. In the US, it's all geographic. Mm-hmm. Well, crypto and digital assets is definitely borderless. It's totally global. It transcends all boundaries. So the regulators have got this problem: is that the law and regulations have been developed on a geographic, territorial basis. We're dealing with an industry that is just totally borderless on there, and that conundrum and puzzle is not going to be solved anytime soon. So, which is why the only thing that they can do in the near term is better harmonization of rules and regulations. But we're still going to have some countries in the world which do not regulate tightly, and therefore, although I believe that institutionally there is a flight to quality, there will still be some exchanges that are flying to unregulated territories, and therefore, as long as we've educated the community that they have a choice to go to quality and regulated exchanges, and some people will have a choice to go to the unregulated places in territories where there is no regulation.
I couldn't agree more. I think Brian Armstrong was saying that if you go and make the environment too strict over here in the U.S., then people are going to go and be in these dangerous waters where they're going to get hit with situations like FTX, and that's really in nobody's best interest.
And not even necessarily too strict, but maybe too ambiguous. And I think that's answering that question of how will regulation impact exchanges, custodians. It's really tough to say, when I think right now we're seeing lots of, at least in the U.S., I'm speaking only to the U.S., a lot of regulation through enforcement, which is tough because it seems like whack-a-mole a lot of the time, where you're not sure. I mean, who knows what will come next, right? Because it's not legislation. It's more the approach, as Duncan mentioned, not on my turf. And it happens fast. I mean, we saw that. I mean, even just thinking about Kraken, right? They've put in a lot of efforts on this proof of solvency and their proof of reserve reports, but they got hit with the whole the staking lawsuit. So it's really tough to say how is regulation going to pan out, at least in the U.S.
All agreed. And, I'll bring up the recent enforcement of Kraken to shut down its staking operation in the U.S. And there was a dissenting opinion from another SEC commissioner, Hester Peirce, who was coming over here and saying that, we've known about this. I should have called for us to put out guidance long before now, instead of just, enforcing policy through, these enforcement actions, right? That's not really in anybody's best interest, but these are hard challenges that we think are going to take some sort of time to figure out. Well, we are coming up on time here, and I did want to wrap up with sort of, our perspective on where we think this is going. What we're calling sort of financial technology 3.0, and it's what we're really building at Accountable to go and enable, let's say, stewards of capital to go and do better, whether that's because they had incentives to be that quality that people fly to, or because they're worried about the regulation. And for us, it comes to this idea that these systems that we've built based on trust are just failing us. So I'll use a hedge fund in this example because I think it's a little bit easier. But nobody would ever just take the word of a hedge fund on how their positions are doing, because there's unfortunately perverse incentive to lie, right? FTX was incentivized to lie about its liabilities here. This is why you usually involve auditors. The challenge here is that FTX had an auditor, And when you're doing a yearly account, a lot can happen between January 2022 and January 2023. And even past that, oftentimes, again, the controls are important here because a lot of times you're actually just passing data down from these brokers to the hedge fund who passes it to the auditors. And if you don't understand how these processes are happening, there's opportunities for tampering of the data. So what we're really trying to promote here are these chains of trusted data where, as opposed to a whisper down the lane scenario, you actually have the ability to go and verify data that's passed between these parties. And we say that the first step here is really by upgrading your system to have these attestations signed by the parties that are issuing them, whether that's a broker or the hedge funds. But use public key cryptography and then leverage the blockchain to go and anchor these things so that they're immutable. And ideally make it so that, as opposed to sort of passing CSV files and having these lengthy reconciliation processes, synchronize the data between parties so that you can go and focus on those controls. And ideally also make it so that these attestations are co-signed by parties that have access to that information in real time. Then you can go and do all these fancy things like utilizing Merkle trees with zero-knowledge proofs. But I think the key concept is that you're taking a legacy portfolio system and adding in these sort of trust attributes, going and showing that we can validate where this came from, that it hasn't been tampered with, and that it's part of a broader portfolio in a way that, again, doesn't require as much trust because you can go and verify what's happening. And I always say that it's sort of like the lock icon for data. Your browser has that little lock icon showing you this connection is secure. We want to go and promote this kind of thing existing for pretty much any data set that you can imagine, where this would be signed and attested to by the parties that are involved. Now, there are a lot of different players involved in financial ecosystems, from depositors and stewards to brokers, auditors, even the tech platforms over here. But we're hopeful that, again, this current stage where these might be a nice to have vitamins are actually a good incentive for parties to go and participate here. So I think the stewards of capital, like exchanges and hedge funds, are the people with the urgent problem here. But again, the regulation is pretty clearly coming. And there are some really interesting things that you can do if you are going to go and say, my books are verifiable. Maybe you have access to additional sources of capital. And, from a depositor's perspective, if you have the ability to validate the assets that are held at these locations, maybe you can actually go and deploy more capital. And from an auditor's perspective, there's an entire new industry that's being built right now that needs to be served. And we want to go and help those parties to go and do that, and hopefully also streamline operations. But again, this is going to take a lot of different parties doing a lot of different upgrades to enable. And I'm really just so grateful that we were able to have this incredible panel here to talk about some of the challenges and opportunities. So I'll give each of you one last chance to sort of shout out if you want to add any different socials here. We have all the information up on the website. We'll share this deck afterwards. But Duncan, is there anything that you're working on at PwC that you'd like to tell the crowd about?
Okay. Yes. Generally, I think whilst we are still in the crypto winter, I think, post FTX and the 2 months after that was everything quietened down. But I'm really enthusiastic about what I'm seeing in the overall industry. There's energy, there's buzz, particularly this month in February. In Asia, it's after Chinese New Year. The way I look at it is that go back to 2015-16, where was the biggest group of people in this industry? It was in China, 14-15. They've moved away from China. They've gone to other places, including Singapore and Hong Kong, now Singapore. Actually, Asia is still going to be a big dominant player in this overall industry. Got some great brains around in this industry. So I am very optimistic about the rest of 2023 in this industry.
Amen. Trevor, any final thoughts from your side?
Yeah, I am extremely passionate just about solving this problem that we've seemed to have of onboarding finance and accounting professionals to the space. I think the digital asset space tried to keep us out for as long as possible, maybe because we're like the nerdy accounting and finance people. But if FTX made anything clear, it's that we're the missing piece of the puzzle, that we need people like Duncan and Gerrit and Omar to be in this industry, because just because it's new technology doesn't mean we can forget about controls, forget about the right risk management practices. And so, yeah, you can find me at multisig.media. I'm on LinkedIn. We're also, as I mentioned, building out a CPE platform to learn more about digital assets and blockchain at learn.multisig.media.
Beautiful. Thanks so much, Trevor. And Gerrit, batting cleanup.
Yeah, not much. Thanks a lot for having me on this webinar, and very excited to be working with Weavechain to bring verifiable financials to DeFi. So
it's an
got a lot of work ahead of us.
Amen. All right. Well, thanks again to all of you. And again, we'll share this information after the fact. And thanks to all of you for joining us today.
Great.
Bye.
Thank you
Thanks,
very much.
everyone.